We're diving into a key part of insurance, risk management. We'll break down what risk is, how insurers handle it, and the different types of insurance companies. By the end of this video, you'll have a clear understanding of these concepts. Let's get started. At its core, insurance is all about risk. Every day, people face the possibility of loss, whether it's damage to their home, an unexpected medical bill, or even the financial burden of losing a loved one. Insurance allows individuals and businesses to transfer that risk to an insurance company in exchange for a smaller, predictable cost, known as a premium. Think of it like this. Imagine you own a car. You know there's a chance you could get into an accident, but you don't know when or if it will happen. Without insurance, you'd have to cover all the costs out of pocket, which could be thousands of dollars. But by paying a smaller premium every month, your insurance company takes on that risk for you, covering the costs if an accident does occur. Risk is simply the uncertainty or possibility of a loss. But not all risks are the same, and insurance companies only cover certain types. First, we have speculative risk. This is a risk where there's a chance of either loss or gain, like gambling or investing in stocks. Since there's potential for profit, speculative risks are not insurable. Then there's pure risk. This type of risk involves only the possibility of loss, with no chance of gain. Think about events like accidents, illnesses, or natural disasters. Since these risks are unpredictable but measurable, insurance companies are willing to cover them. When an insurer takes on risk, they look at exposure, which refers to the specific conditions or situations that could result in a loss. Factors like an individual's age, occupation, or health status all contribute to their level of exposure. The higher the exposure, the greater the risk for the insurer. Now, let's talk about what actually causes a loss. A peril is the direct cause of a loss, things like fire, theft, or a car accident. Insurance policies clearly define which perils they cover and which ones they don't. But beyond perils, insurers also consider hazards, which are factors that increase the likelihood of a loss or make a loss more severe. There are three main types of hazards. Physical hazards are visible conditions that increase risk. Think about a cracked sidewalk that could cause someone to trip or faulty wiring that could start a fire. Moral hazards are risks that come from dishonesty or intent to cause a loss, like insurance fraud. For example, if someone deliberately sets fire to their property to collect an insurance payout, that's a moral hazard. Morale hazards come from carelessness or indifference. If someone leaves their car unlocked because they figure insurance will cover it if it's stolen, that's a morale hazard. Understanding these hazards helps insurers determine who qualifies for coverage and how much they should pay. Insurance companies don't just take on risk blindly, they use strategic methods to manage it. These strategies are summed up by the acronym STARR, which stands for sharing, transfer, avoidance, retention, and reduction. Sharing spreads risk among multiple parties, like in group insurance. Transfer shifts risk from an individual to an insurer, which is the core idea of insurance. Avoidance means completely eliminating a risk, like choosing not to drive to avoid car accidents. Retention is accepting the risk and covering any losses yourself, like choosing a high deductible on your insurance policy. Reduction means taking steps to lower the likelihood of a loss, such as installing a security system in your home. Another important principle in risk management is the law of large numbers. This states that the larger the group of insured individuals, the more accurately insurers can predict losses. For example, if an insurance company covers 100,000 drivers, they can estimate how many accidents will happen each year, allowing them to set appropriate premiums. For a risk to be insurable, it must meet specific criteria, remembered by the acronym CANHAM. Risks must be calculable, affordable, non-catastrophic, homogeneous, accidental, and measurable. This means insurers must be able to estimate the cost of potential losses. Premiums must be reasonable for customers. The risk can't be catastrophic like war. It must be similar enough to other risks for prediction purposes. The event must be accidental and not intentional, and the loss must be measurable in clear terms. One major challenge insurers face is adverse selection. This happens when people who are more likely to experience a loss seek insurance at higher rates than those with lower risk. For example, if only sick people buy health insurance, the company will face more claims than expected, leading to financial losses. To prevent this, insurers use medical exams, questionnaires, and risk classification systems. To further protect themselves, insurance companies also use reinsurance. This is when one insurance company transfers part of its risk to another insurer to avoid major financial losses. There are two main types of reinsurance. Facultative reinsurance is when the reinsurer evaluates each risk individually before accepting it. Treaty reinsurance is when the reinsurer automatically accepts risks based on a prearranged agreement. Not all insurance companies are structured the same way. There are three main types. Stock insurers are publicly owned companies that issue non-participating policies. If they make a profit, they may pay taxable dividends to shareholders, but not to policyholders. Mutual insurers are owned by their policyholders. If the company earns a surplus, it may return some of the excess premiums as non-taxable dividends to policyholders. Fraternal insurers provide insurance and other benefits exclusively to members of a specific society or group, such as religious organizations or fraternal lodges. Each type of insurer operates differently, but they all serve the same purpose: managing risk and providing financial protection. And there you have it. We covered everything from the basics of risk and hazards to how insurers manage risk and the different types of insurance companies. These are fundamental concepts for your life insurance exam, and understanding them will give you a strong foundation in the industry. If you found this video helpful, be sure to like, subscribe, and check out our other exam prep content.